Hello, everyone, and welcome to today's NOVA presentation, 401k Loan and Distribution Basics, presented by Melissa Kaywood. Before we get started, just a few housekeeping items. At the top, there's a question mark. You can go ahead and ask any questions here that you may have. We may not have time for all the Q&A portion, but if we don't, just email your questions to webinars@nova401k.com, and we'll make sure those questions get answered. Right next to the questions, you'll see a paper icon. This is a handout. I haven't been able to attach the handout, so it'll be available soon. If you do need today's handout, you can email us and we can get that to you. If you're here for continuing education credits, please be sure to stay until the end to fill out the pop-up survey. This will allow us to continue to track your time and participation. Certificates will be sent out within a week of those that have met the time requirement. To view any past webinars, you can visit our YouTube channel, which is Nova 401k Associates, or visit www.nova401k.com/webinars. Thank you for joining us, and now I'd like to introduce today's presenter, Head Trainer and Reviewer of Distributions, Melissa Kaywood.
Thank you, Ava. Yes, so I am the trainer for the distributions team. I also do a lot of the review. I help make sure that our team here at Nova knows exactly how to process any participant requests that come in and stays on top of any kind of law changes and things like that. So before we get into the agenda, let me just have this disclaimer. This webinar is for about an hour and a half. I extended it. Last time I did this, it was an hour, and I felt like I was rushing and I did not have time for questions. So at this one, we might not need the full hour and a half, but I wanted to leave plenty of time for questions. And if I can give you a few extra minutes back into your day, I want to do that as well. But an hour and a half is nothing when it comes to these distribution and loans. So this presentation is going to be very general in nature. I could talk about each individual type of distribution or about loans for 6 hours at a time. And of course, we just don't have enough time for that. So this is going to be really general. I am not an attorney. I am not a CPA, so I can't be a substitute for legal or tax advice. If you have something like a very detailed question about a specific situation, it may be better to contact an attorney or a CPA depending on that situation. But also, if you have an idea for a webinar that you would like to see us do in the future where we deep dive into one particular topic, let us know. So moving on from that, as Ava said, that there is a continuing education credit available with this. Just be present for the entire seminar and be sure to complete that evaluation form at the end. Okay, so let's look at our agenda. We are going to go over distributions and just the different types and then issues around taxes for those distributions. Then we'll go into the loans and we'll talk all about like maximum loans, what happens if a loan isn't repaid, things like that. We will look at vesting, and vesting does affect each participant's distribution and loan request. So it's really important to understand that. We'll look at avoiding the most common problems. When we have these requests, the thing that people want is for them to be processed as fast as possible. So the best way to do that is to avoid problems on the front end. So we'll look at that. And then, of course, we have to talk about cybersecurity, since when we're looking at distribution and loans, we're looking at participants' accounts. And, that's going to involve very detailed things with PII, social security numbers, dates of birth, things like that. So we have to talk about cybersecurity. Learning objectives, like I said, it is going to be general. I don't expect anybody to walk away here being an expert on everything about loans, but I do hope that you understand what distributions are mandatory versus which ones are optional that can be made from these 401k plans, and to be able to identify loan provisions, which ones are different individual provisions in a plan versus what are actual guideline, like regulation requirements in these 401k plans. And then understand how vesting does affect and apply to individual participant loan and distribution requests. So with that, let's dive right into the distribution basics. All the time, I speak to participants who do not understand that the money that goes into these 401k plans cannot just be withdrawn at any time. Once money goes into a 401k plan, it has to meet certain criteria before it can be withdrawn or distributed from that plan. A lot of people think that they're more similar to savings accounts, and they are definitely not. And I can't blame anybody for not knowing that. Before I started working at Nova, I really didn't know that either. So, it's why we have this education out there. We want to make sure people know. In the industry, we call it a distributable event. Some kind of event has to happen that will trigger the ability to take money out of a 401k plan. And some examples are there on the screen. If a participant terminates their employment, if they retire, if they reach a specific age that triggers them to be able to take what we call in-service distributions, if they're experiencing a hardship, if the participant dies, or if they become disabled, and then potentially if they have rollover money, they can take a distribution of that. So we're going to dive into each one of these on the following slides. Some are optional and some are going to be required. So right off, first one, most common one, is the termination of employment or retirement of the participant. Once that event happens, their final day of work has been completed, they no longer work for the plan sponsor, they are eligible to take their money out of the plan. This is a voluntary distribution. It is going to be initiated by that terminated participant. This is not going to be the plan sponsor forcing the person to, hey, I don't want you in my plan anymore, take your money. Termination is voluntary. The funds cannot be removed until after the termination date. Frequently, especially it happens a lot with people retiring, they know that they're retiring at the end of the month and they want to go ahead and just get all their ducks in a row and submit paperwork in advance so that everything's ready to go. But unfortunately, most of the time that paperwork is going to be dismissed by the record keeper. We're not going to be able to submit anything until after that final day worked has passed. So it's great to give them the paperwork in advance, but they can't actually turn it in until, they can turn it in on their last day worked, and then we can get that turned into the record keeper that following business day. Another thing to consider is the final payroll contribution. So if the participant has been getting contributions every single paycheck, and that's going to include their final paycheck. So if I terminate my employment today, but my final paycheck isn't until next week, I'm still going to have one final contribution next week go into my account. So it is oftentimes better to wait until after that final contribution or after that final paycheck has been processed before we submit any distribution paperwork. With that being said, you don't have to do that. The record keepers will process it the day after, business day after their termination. But the participant just needs to understand that they may have to submit paperwork a second time to get that final contribution out of the plan. Some record keepers will process it automatically. They kind of look at it as a trailing, contribution, and they just pay it out immediately upon, the original distribution instructions. Some of them won't do that. So it can depend on your specific situation. There's also potentially additional fees. If they're having to fill out new paperwork to get that final contribution, they could be charged a secondary fee. So just something to keep in mind. Okay, let's look at involuntary force out distributions. Now, these also happen after a participant has terminated their employment. It is a situation where the plan sponsor can force a participant's account out of their plan. But it's a very strict situation you have to fall into in order for that to happen. Not every participant is eligible to be forced out. And what these do is they remove small account balances from the plan. And it sounds kind of harsh, forcing people out, but you cannot do it without giving the participant proper notice. They have to be given at least 30 days notice and be told things like, hey, you're eligible for a distribution. Here's how to take that distribution. If you do not take that distribution within 30 days, your account may be forced out of the plan. So they are given notice, they're given a chance to make their elections before this happens. And then if it's, they don't do anything, they don't act on it, then we can move forward. The force outs are a good thing because for the plan sponsor, it helps to keep their plan clean, generally speaking. It limits those lost participant accounts. And once the account has been forced out to an IRA or cashed out, that participant no longer is included in your 5,500 count. So, there's several reasons why that is good, right? If you have too many participants in your plan on your 5,500 count, you could be subject to audits. I know that some pricing is done based on the number of participants that are in your plan. If you have a lot of small account balances driving down your average account balance size in your plan, then it could affect your pricing with your record keeper. So it can help in those situations for the plan sponsor. So there's two different thresholds that a plan can adopt. A plan can choose to do the $1,000 threshold, and they could choose to go all the way up to $7,000. And then, in addition to that, if participants have money that they have rolled in from outside sources, say from their prior companies that they've rolled into your plan, you can choose to either include that rollover source when looking at if the participant is below a threshold, or you can exclude that rollover source when trying to determine those thresholds. What a plan chooses to do is greatly going to depend on their specific demographics, and what is right for one plan may not be right for another. So just something to keep in mind, there are options here for the plan sponsors. Okay, so let's talk about the $1,000 threshold. If a plan chooses this threshold, then the account balance is going to be paid in cash to that participant. The distribution is taxable because they are receiving cash. Any federal withholding and state withholding is going to be taken out. On the screen there, I have 80% of the balance is going to be mailed in a check to the participant. I live in Texas. We don't have state income taxes here, so that's true in Texas. That might not be true for every state. So the state taxes is also going to be withheld. They could get less than that, but it'll be withheld. It'll be sent to the appropriate place for that tax withholding, and then the participant will receive a check in the mail. They're also going to receive a 1099-R the following January, showing that they've already paid the taxes, and it'll help them file their taxes. The issues with this one is that the main issue is that it's going to, I should say it could, but it's likely going to create an uncashed check issue for the plan. If the participant, they got or maybe they didn't get the original notice. Remember, we have to send that 30 days notice to them. If they didn't receive that, there's a great chance they're not going to receive that check either. Things happen with the mail all the time. It gets put in the neighbor's mailbox, and maybe that neighbor isn't the best and doesn't tell them. They just do whatever with it. Maybe they thought it was junk mail, they threw it away. Maybe they have kids like I do who throw things away for no reason, it seems like. Anything could have happened, and if they didn't get the original notice, there is a chance they're not going to get that check as well. So then you have we've kind of traded one problem for a different problem. In your plan document, you can elect to put in a minimum rollover amount. And like what I know we like to do at Nova is put in $1 is the minimum rollover amount. So effectively, we're not paying anybody in cash. We're going to roll everybody to an IRA that we open on their behalf. And that is what you have to do if the balance is more than 1,000. You can go all the way up to 7,000. It used to be 5,000. In the Secure 2.0 Act, they did increase that limit. So now it is 7,000. And if your plan says, it's above the minimum rollover amount, or under the regulations, if it's above 1,000, you have to roll it to an IRA. And there's so many solutions on the market out there right now. Almost every single record keeper has their own rollover options available. I know at Nova we use Qualified Trust Company. So there's lots and lots of options out there. And what happens is you open an IRA on behalf of the participant. their account balance, entire account balance, is moved to that IRA. It is not taxable or anything like that. They do get a 1099-R the following January. And then, of course, the rollover company will provide them with a welcome kit and instructions on how they can access their funds at that point. Okay, so if you're interested in this, please, I've got our email on the screen there. Reach out to us. We do a yearly project for our clients that are with specific record keepers. But if you're interested in a custom project or anything like that, we can definitely still help with that. All right. Let's move on and let's talk about some other distribution options, like when the participant is not terminated employment. The most common one of these are going to be called in-service distributions. I have age 59 and a half on the screen because that is the most common age at which in-service distributions are allowed. However, your plan document can be written differently. This is an optional plan provision. The regulations allow for participants to make in-service distributions, but your plan has to elect to include this provision. What it does is it allows the participants to take a distribution while they're still employed. And you, as a plan sponsor, can put all kinds of restrictions in there. You can restrict the money types that are available. You could say only employee money can be taken. You can restrict, add timing restrictions, only one per year, things like that. With the age, the IRS states that elective deferrals and safe harbor contributions cannot be taken prior to age 59 and a half. And so a lot of plan documents will just use 59 and a half in there. There are some plan documents, though, that make it even more restrictive. They say once you reach the normal retirement age under the plan, then you can take an in-service. We have others that are more lenient towards other sources, like the profit sharing source. There is no age range for when you can be eligible for an in-service of profit sharing distributions. So a plan could put any age they want in there. I know I actually worked on one last week where the age was 35, but that only applies to that specific source that it's in the document. 59 and a half must be the minimum age for deferrals and safe harbor. Most of the times when you're writing a plan document, you want it to be as easy and to administer as possible. So people like to stick with 59 and a half just because then they don't have any concerns about which money type and things like that. But again, you can get really customizable with your documents. For these, there is no early withdrawal penalty if you are 59 and a half or older when you're taking your money out, if you're taking cash. If you did have a provision that was earlier, like for your profit sharing funds, that 10% penalty tax would apply. It is going to be subject to normal federal income taxes and, of course, state taxes as well, if that applies for your participant. So it's definitely something they'll get a 1099-R the following January to help them file and things like that. But it's just something to know that it does exist, but it does not have to be utilized. Another optional provision is the hardship distribution. And hardships have been in the news a lot over the last several years because there's been so many changes. Really, since 2019, we have had change after change with hardships. So I want to kind of go over them. It's an optional provision. Again, you do not have to allow them in your plan document. It gives the participant access to their 401k account in the event of an emergency. There, again, you can put restrictions on there. You can restrict the money types. You don't have to, but you could. You can put timing restrictions, again, one per year, or any kind of restriction in there as far as that you want, 2 per year, whatever, 1 every 6 months. You can do that. These are going to be subject to taxes, of course, and if they're younger than 59 and a half, they're going to be subject to that penalty tax as well. The penalty tax is 10%, sometimes called excise tax. It's a tax you have to pay if you are not retirement age according to the IRS and you're taking cash. Hardship distributions must be taken in cash. They don't have a choice to roll these over. They're for the purpose of helping the participant out of an emergency situation, so it wouldn't make sense to do a rollover. And documentation may be required. I put maybe because with Secure 2.0, they do allow us now to rely on the participant self-certification that they have a hardship. Your plan does not have to do that. If you want, you can still require documentation like we kind of did before Secure 2.0. Documentation is going to be things like eviction notices, invoices, potentially, bills, receipts. In very rare situations, you typically cannot pay yourself back, cannot get reimbursed with a hardship. This is, that at that point, it's usually debt, and debt is not an allowable reason in most cases. Let's talk about the reasons. So there's two different ways to define what a hardship is in your document. And almost everybody is going to use the safe harbor definition, and that's what this slide goes over. The other definition, it's kind of an outdated term, but you'll hear people say facts and circumstances. Basically, the participant will present their situation to the plan administrator, who will determine if it's a hardship or not. It's very difficult because, you have to do things uniformly across all your participants. You can't give preferential treatment to one participant over the other. And when people are bringing you such a, varied situations, it can be a little difficult. But one thing's for sure, if somebody's trying to buy a big screen TV right before, Super Bowl Sunday, that's probably not a hardship. That's more of a want. That's not a need. If somebody is, their car has broken down and they can't get to work without getting the car fixed, but they need the hardship to fix the car, I could see a plan sponsor, plan administrator approving a hardship in that situation. But under safe harbor definition, that does not apply. These 7 reasons on the screen are the only ones that apply for a safe harbor definition hardship. And it's kind of a downside to some participants because maybe they could argue they have a hardship for their specific situation. But when you're looking at administering a plan, you need it to be easy to administer. Plan sponsors, their job is not to deal with a 401k plan. They have their own business to run. So we need things to be easy. And so that's why most people just use this definition. These are guaranteed to, under the IRS rules, these qualify for hardship. So the things like purchasing a primary residence, preventing foreclosure or eviction on a primary residence, unreimbursed medical expenses, post-secondary education, that is, college, university, that is not private school, K through 12. Casualty losses, this is home repair, and it's got to be for your primary residence. It's got to be due to an event that was sudden, unexpected, or unusual. It can't be when my roof is 20 years old and started to leak. That's wear and tear. That's not a casualty loss. A tree falling on your roof and now your roof is caved in, that is a casualty loss. Burial expenses, this can be for the participant's spouse, children, parents. And then hardships incurred as a result of a federally declared disaster. So that one sounds a little bit like casualty losses because it could involve home repair, but it's actually expanded. It can also be, cover things like, if they missed out on earnings because they weren't able to make it to work because their area was flooded, or, if their car was flooded. It just expands that option a little bit. Okay. For the federally declared disaster, it has to be declared by FEMA, and it has to be declared for individual assistance, not public assistance. So it is a little bit, detailed in there, but let's move on and look at these different changes. So the first thing you're going to notice probably on that screen is that I'm talking about changes that were from 2019, and yet I'm calling them recent. And the reason I still want to go over these changes, even though now we're looking at 6 years, is just because I still have people ask me, wait a minute, I thought, like the first bullet point, that you had to take a loan before you could take a hardship. And that did used to be true. You're definitely not crazy for thinking, wait, I thought this was the case. It used to be the case. Especially with smaller plans, they may not have participants taking distributions very often, and so maybe they don't realize that there's been all these changes. So that's why I'm still talking about them. You no longer have to take a loan. That used to be a requirement, and then it was kind of causing different burdens for the participants because they had to make those longer payments. So their paychecks were now smaller. So it kind of ended in a vicious cycle for some people. It used to be that you could not take your investment earnings on any deferrals. And so before, when we processed these, we had to go and look at what they actually contributed, and we could not let them take more than that, even if there was more in that account. The earnings couldn't be touched. And now we don't have to worry about that anymore, which is very nice. You used to have to stop contributing to the plan for 6 months. And this one, the idea was, well, if you don't have enough money to pay your rent, maybe let's stop for 6 months, help you kind of get back on your feet, and then you can restart your deferrals and things like that. But I think luckily what the IRS realized is that, sometimes there's like a one-time event that happens and it throws everything out of whack for that 1 month. Maybe there was some kind of medical diagnosis and they just were met with like all these bills all of a sudden. It's a one-time thing. It's not going to happen in the future, or whatever. Those participants were being punished and made to sit out on deferring, and they missed out on so much, deferrals and then potential earnings on those deferrals for those 6 months. So the IRS did take that out. And before, we were really strict on what the regulations allowed us to withdraw as far as sources go. Now they don't have those restrictions. So under the regulations, Safe Harbor, QNEC, and QMAC contributions can be taken. That said, like we talked about earlier, a plan document can be written to exclude those sources if they want to, but that's going to be a plan by plan basis. That's not going to be because of regulations. Okay, more changes. So then at the end of 2022, we had different things. So we can now use self-certification for hardship instead of requiring documentation. If the plan chooses to allow that, participants will complete a self-certification form. It's going to detail what the rules about hardships are, the reasons that qualify for hardship, and it's going to have a spot where they have to, say the amount of their hardship. They'll have to, sign it and date it, certifying that they understand that they do meet the requirements for hardship. It also tells them that they need to keep their documentation. It doesn't get rid of the idea that documentation will ever be needed. It just moves the burden from the plan sponsor to the participant. So when a plan is audited, the auditor is going to look at the self-certifications and allow that's going to be fine. If a participant is audited, with their taxes, they potentially could be requested to show that documentation at that time, but the plan itself is going to be fine. The reasons we like self-certification is obviously way faster to process these. There's a lot less paperwork and red tape for participants. It used to be, so much back and forth when needing documentation. And if somebody, especially like with medical bills, a lot of participants felt really uneasy about turning over their medical bills because sometimes there's information on there. Now, yes, we still have to, be in with the law. We can't share their information and things like that. And we do follow all the laws, but it makes the participants really uneasy. They don't necessarily know what NOVA is when they're showing us documentation. So it definitely helps to ease all those concerns. And the participants do still have to qualify for Safe Harbor reason. If your plan was to use a definition other than Safe Harbor, you cannot use self-certification. You have to require documentation. This is only for Safe Harbor defined hardships. But we also like this because it just eases that administrative burden on the plan sponsor. When we get a hardship that's not in good order because of documentation, it might be bills, but it shows they're all paid or something like that. We got to go back and forth and back and forth. And that just takes, time away from the plan sponsor's day as well. So it's just an all-around easier process, but it might not be for every single plan. If you, as a plan sponsor, aren't comfortable with your plan participants just signing off on things and you want documentation, that's absolutely still acceptable. So just knowing that this is an option is good, but you don't have to use it. Okay, I could talk about hardships forever, I swear, but we're going to move on right now to rollover distributions. This is available when a participant has rolled money into the plan from an outside source. So not every plan is going to have this. It's an optional provision. your plan doesn't have to allow rollovers in. So it just kind of depends. If it came from an IRA or from another company's 401k plan into your plan, then the plan document can allow this to be taken as a distribution. When it allows this distribution is not going to be tied to an age restriction. It's going to be they can take it at any time and for any reason. They don't have to have a hardship or something like that they have to prove. Basically, they could have chosen to do anything with that money, and they chose to move it into your plan. So if you allow them to take it out, it's just going to be at any time for any reason. We like these because it encourages the participants to roll over into the plan. We want to get those account balances up, and we want more participants to join your plans and to have those bigger balances. Well, if they don't allow rollover distributions, then participants may be more hesitant to roll into the plan because they always have that tendency to think, well, what if I need this money? And so they might want to keep it out of the plan. So by having this distribution available, a lot more people are willing to move it into your plan. It is going to be subject to federal income tax, state taxes, and then also that 10% penalty tax if they're younger than 59 and a half. Of course, that's only if they're taking cash. They can roll over their rollover funds to an IRA if they want to, and then no taxes would be involved. Okay. Death distributions. These are, obviously they happen. It's a reality of the world we live in. So when this happens, somebody passes away, the first thing that we're going to do is look for a beneficiary election form. Did the participant name their beneficiary? If they do, you should have beneficiary election forms. The plan sponsor really is the one responsible for maintaining these. I know that with some record keepers, they do have the option where if you send them in, they'll hold them and then you can look it up online and things like that, and that's great. But what we need to remember is that, when a participant gets married or if they get divorced, the record keeper is not necessarily going to have that information. The first party that's going to know is going to be the plan sponsor. So that's why it's always good for the plan sponsors to stay on top of their beneficiary election forms. Definitely encourage your participants to fill them out. I don't know if other people would be shocked by this, but I am shocked by how few people actually fill them out. So with married individuals, your spouse is your beneficiary, but sometimes two people do die at the same time. So if you don't have a contingent beneficiary named, it can get a little bit tricky. If a married participant wants to name somebody other than their spouse, then they can definitely do that, but the spouse will have to sign off on it and agree to that, to give their consent to that election. So if an election is not available, the participant never completed one, we're going to look at the plan document itself. I love going to the SPD. It's written just so easy to understand. It just has a little chart in there. And typically what's on the screen here is normal. I have seen it a little bit different, but the spouse is always going to be first. There's no election and they're married, it goes to the spouse. If they do, if they're not married, then if they have any children, it's going to go to the children in equal shares. 2 kids are each going to get 50%. The next line is the one that I've seen be different. I have seen most of them say parents, and that's going to be in equal shares as well. But I have seen some that say siblings in equal shares. So just look at your specific plan document to know exactly what it says. And the final is going to be the estate of the participant. So whenever, the beneficiary sends in their distribution form, they must also send in the death certificate, and we're going to look at that. If they have multiple beneficiaries, maybe they wanted to give half to this person, half to that person, each beneficiary will need to fill out their own form. I know at Nova, when we're doing that, we do have distribution processing fees, but we split the fee evenly among the beneficiaries. We don't charge double fees or anything like that. So do have to have separate forms because each beneficiary gets to make their own election, but at least not double fees. Okay, so let's move on and talk about RMDs. It's August now. We're really going to start ramping up, and you're going to hear a lot more about RMDs from Nova if you're a Nova client coming up very soon. These are sometimes referred to as age 73 distributions. but it hasn't been 73 for very long. It was 72 for like a year, and it was 70 and a half for a really long time. So sometimes, especially if you're looking online and stuff, you may still see 70 and a half. People are still used to that term. What this is an annual requirement that certain employees have to begin taking money out of the 401k plan. These plans are not designed for somebody to build wealth for their heirs. They are designed to be used in retirement. So once the participant reaches age 73, then they potentially become required to take these minimum distributions. Generally, it's going to apply to terminated employees who've reached age 73. If you are still working, then you do not have to take the RMD unless you are a greater than 5% owner of the company that sponsors the plan. So if you're not a greater than 5% owner, and you're still working, then that's understandable. You're not retired yet. You do not have to take these distributions because you're not. It's not like you're retired and just letting the money sit there. You are still working, so that's fine. You can delay it until your year of termination if that applies to you. But the greater than 5% owners, they don't get that luxury. They have to do it. Your first year, you can wait until April 1st of the following year. So if somebody's 73 and they terminate in 2025, they have until April 1st, 2026 to take that RMD. But for 2026, they only have, and for every subsequent year, they only have until December 31st. It has to be taken before that end of the year. So a lot of people like to wait. For some people, it might make sense. For other people, it might not, because having 2 withdrawals in 1 year for that one, like that first time they start taking RMDs, that creates a tax burden. What it's doing is creating tax revenue. These distributions must be taken in cash. They are required. They do not have the ability to roll them over, and they are taxed. So when somebody says they want to wait, it's just the only thing we want to consider is that tax burden for them. Let's see. Nova will initiate this for Nova clients. We do have some participants that throughout the year want to go ahead and take it, and that's totally fine. If a participant is eligible to start taking RMDs and they have not taken it for the year and they want to roll over their entire balance, like to an IRA or something, we have to take the RMD first. The RMD is a requirement that a specific amount must come out of the plan in cash every year, and that amount is not eligible for rollover. So we put that distribution on hold, we do the RMD, and then we do the rollover. That's the one thing that makes a lot of participants are surprised by that. They think, well, I know I have an RMD, I'll just take it from my IRA. You cannot do it. It's not eligible for rollover, so we have to take that amount out first. They think, well, I'll do it in the beginning of the year because it's not 12/31 yet. I have until the end of the year to take it. That's true until they're trying to roll over their money. So just something to keep in mind there. The other thing to keep in mind is that once you start taking RMDs, you cannot stop. So I have that joke that they're like Pringles, once you pop, you can't stop. So sometimes people will think, well, I took an RMD, but then they come back to work. They've already had RMDs come out of that account. It doesn't matter. They got to keep taking them. So just something to keep in mind there. But like I said, for Nova clients, this is Nova initiated. As plan sponsor, will give you everything you need. Okay, let's talk about quadros. It's a qualified domestic relations order. This typically comes up in the context of a divorce. However, it could come up in the context of back child support as well. What happens is it will award an amount of the participant's account that is going to be distributed to an alternate person, usually the ex-spouse. And the rules are very complicated. ERISA is the group of rules that govern these plans, and they are very, very detailed with quadros. ERISA is written to be extremely protective of participants and their rights and their assets. And so in order to take money out of a participant's account and pay it to somebody, not on behalf of the participant, but on behalf of a different person, I have to have this document. And it has to hit all of the requirements under ERISA. So we have like a whole checklist that we'll look through and make sure. It's definitely not a one-day process. If you, as a, you're a NOVA client and you get a quadro from one of your participants, all you have to do is send it directly to us. Usually they initially come in as drafts, and they'll come with a letter from the attorney saying, hey, can you look this over? Let me know if it's good, if it's approved before I send it to the court. A judge will sign off on these. And I know it can be a little overwhelming for some plan sponsors, especially if you've never seen them before. They look, they're legal documents, but we will go through that with you. We have an acceptance letter, a rejection letter. If something needs to be fixed, we'll work with that attorney, make sure they know what needs to be updated. And then we send out distribution paperwork to that alternate payee so that after the judge has signed it, they can make their actual request and we can get that distribution processed out of the plan. So send them to us if you have them, and we'll look over it with you and take care of it for you. Okay, spousal consent. Good news here. I think most people will think this is good news. Most 401k plans do not require spousal consent. It just makes that administrative burden a little bit easier, a little bit faster to process distributions, things like that. Even if your plan does have spousal consent requirements in it, it is not going to be required for distributions that are under that force out limit. In the very beginning, we talked about forcing participants out and the thresholds that the plan can choose. On the screen, it says 7,000 because that's the most common threshold that people are going to use. They want to use that maximum. And so if the distribution is under that threshold, basically, if I don't need the participant's consent to force their money to an IRA, then I don't need their spouse's consent whenever they're taking a distribution request. It's kind of how I look at it. So it says 7,000 on the screen, but if you have a plan that has chosen to stick with that $1,000 threshold, then that number would be 1,000 for that particular plan. The plans that are subject to spousal consent are plans like that have old money, purchase money assets in there, defined benefit plans, your DB plans, your cash balance plans. Plans with annuities are going to have that spousal consent required. Your average everyday 401k plan will not have those requirements. All right, special tax notices. These have to be given to a participant whenever they're requesting a distribution. So if a participant is going online, let's say your record keeper has that online capabilities, then the special tax notice is going to be as part of that process. Basically, it tells the participant, how distributions from the plan are taxed, about that 10% penalty or excise tax that may apply to them if they're taking cash under the age 59 and a half. And then it tells them how to avoid taxes, which you do that by rolling your funds over rather than taking cash. So it just gives them all that information so that they're not surprised when their distribution, if they take cash, is less. They know that taxes were withheld, and they know that they're going to get a 1099-R to help them file their taxes that following January. Okay, so for cash distributions, we have the 20% withholding rules. That 20% is mandatory on any distribution that is eligible for rollover. The two that are not eligible are hardship and the RMDs, required minimum distributions. A hardship, it's for an emergency. It doesn't make sense to roll that over. They do not have mandatory withholding rules under the regulations. A participant can choose if they want 20%, they can choose 10%. That's kind of more common. It's a default. Or they can choose 0% if they want. That does not get them out of their tax liability. It's just how much do they want withheld from this particular distribution. Some people want 0, and then they choose to pay the IRS at the end of the year, and that's totally fine. Maybe they know that they are paying extra in taxes somewhere else, and so it evens out for them. I don't know, but they will receive a 1099-R anyway, showing them. RMDs, same thing, the default is 10%, but they can elect whatever tax withholding they want. I've seen an RMD with 100% tax withholding, and I've seen an RMD with 0% tax withholding. They're not eligible for rollover, so they get to choose anything else, termination, a in-service withdrawal, that rollover distribution, quadros, death distributions. 20% is going to be withheld. State taxes may also apply. The 10% excise tax, that is going to apply, but it is not going to be withdrawn from their distribution. It's just something that they will have to handle when they file their personal income taxes. With rollovers, if they are rolling the money to an IRA, to another plan, things like that, they defer taxation. They do not have anything withheld, no state, no federal, and they are going to get a 1099-R that just shows the taxable amount as zero. So 1099-Rs are still required no matter what, as far as where that money goes, but it doesn't necessarily mean that they owe taxes. Okay, let's move on and talk about loans now. Loans are another optional provision that you can have in your plan document. And this allows your employees access to the 401k plans, which will encourage participation. Again, we want participants to be excited about participating in the plan. We want more participants to join. And this is one of those things that participants love. They love loans. Plan sponsors don't always love loans because loans are usually paid back through payroll deductions, and you got to get that set up. And, sometimes that can be harder to handle depending on the situation. But the good news is that you can add restrictions into your document. Just because you allow loans does not mean it has to be a free-for-all. You can put things like, restrict the number of loans. You can restrict one loan at a time. You can put waiting periods in between loans. When a loan is paid off, you have to wait 6 months before you can take another one. You can restrict the money types that are available for a loan. If you want to say only employee sources are allowed, you can do that. So there's lots of restrictions. You can also restrict it to say loans are only available for hardship reasons, meaning the participant would have to have one of those 7 safe harbor defined reasons, preventing eviction, medical bills, etc., before they could have a loan from the plan. You can do that if you want to. An amendment, if your plan does not allow loans and you want to change that, you will need to amend the plan. And then, of course, you will get a loan policy that details all of this. It's written kind of like an SPD, that easy to understand language that you can hand to your participants so that they know what the rules are. All right, the first thing people want to know when they're requesting a loan is how much can I get? And this is going to be determined ultimately by the regulations. The regulations state that participants can borrow 50% of their vested account balance up to $50,000. That $50,000 is also reduced by the highest outstanding loan balance in the last 12 months. So because $50,000 is 50% of $100,000, that reduced by the highest balance is not really going to affect anybody with a smaller account balance. That's going to affect people as they get closer to that 6-figure account size. When writing a loan policy, of course, for our plans, if a plan sponsor wants to do something, we'll absolutely write the document that way. But we would recommend that a plan limit it to 1 loan outstanding at a time, a minimum loan amount of $1,000. With the regulations state you cannot put a minimum in that's higher than $1,000, but we do recommend sticking with that $1,000. A plan could be written to have a lower loan amount, but then the less and the easier the burdens are on the loan restrictions, the more loans your plan is going to have. And generally, spousal consent, we don't think is needed. It shouldn't be required. Okay, under the regulations, it states that you have to have a reasonable rate of interest. The word reasonable is not explicitly defined. And, if you pull 10 people off the street, you could get 10 different answers as to what is reasonable. However, across the industry, people typically use the prime rate. And a common thing that we see in our documents is prime rate plus 2%. So if prime rate is 7.5%, then a loan in that document would be using a 9.5% interest rate. People like using the prime rate because, their loan interest rates in their plan are going to vary as the loan interest rates around the country are varying. You don't have to use that Prime Plus 2. We do have some plans I know that use Prime Plus 1. I've seen a plan have a flat interest rate of 10%. It just has to be reasonable, something that, it wouldn't be reasonable in today's world right now here in the US to have a loan interest rate of 1%, right? So the maximum term that is allowed under the regulations is 5 years. It does allow for people to take longer than that if they are using the loan to purchase their primary residence. You could go up to 20 years if you wanted to. That's a restriction, though, that you can put into your plan document. You could say we're only going to allow 10 years for those mortgage loans if you want to. So just keep that in mind. I don't like the super long repayment terms for loans because you got to think these loans are typically made through payroll deduction. And what's the likelihood that that participant is still going to be working for you in 20 years? Is that loan going to get paid off? Is that, a reasonable thing? So that's why some people like to restrict it at 10 years. But yeah, only for home loan, they do have to provide documentation showing that they are purchasing a home. They cannot take more than they need in cash in order to close on the home. And that's only if they're going above the 5 years. If they're buying a home, but they're sticking with 5 years, then they can take up to that statutory maximum we talked about earlier. These loans are paid through payroll deduction, and one thing that people don't, I think it makes sense if you think about it, but people don't really think about it, is that it's going to be paid on a post-tax basis. So if that loan was taken out of a deferral source, the participant gets it, then when they make their repayments are it's coming out of their paycheck. The paycheck's already been taxed. It's coming out of their paycheck back into that deferral source. Then when they take a distribution at retirement, they pay taxes on that again. So it's just something to think about, something that the participants should be aware of. If you don't do it through payroll deduction, it's still going to be done on a post-tax basis. It's going to come out of their bank account. Theoretically, all the money in their bank account's been taxed as well at one point. So, but we love payroll deduction because it's, then you're not relying on participants to remember their monthly bill and send it in every month. It's just easy. You set it up through payroll and it happens automatically. Loans generally become due upon termination of employment. So when the participant is no longer working there, they can only miss so many loan repayments until the loan is considered to be in default. And, they would need to pay it off in full. Also, if they make a termination distribution request, then that loan is going to be offset at that time. They're not going to hold that loan open after the participant has closed their account. When they close the account, they're closing the loan as well. So we'll talk about, I have a different slide for what happens when a loan isn't repaid, but basically, hence its taxes happen. So, okay. So your loan policy, we have these statutory requirements under the regulations, but then your loan policy can have its own requirements. The loan policy is extremely important to understand. If we do not follow what that loan policy says, then the loan itself could be considered a prohibited transaction. And that's going to mean that it's going to become taxable, and that could further inflict those excise penalties on the participants as well. So we want to make sure that we are processing loans according to your specific loan policy and your plan. Okay, for the fees, there is, if you're a Nova client, there is a fee to initiate that loan. There's also oftentimes the record keepers have loan initiation fees. Not all of them do. What they all usually have is a maintenance fee. Nova does not charge any maintenance fees for loans. The record keepers do. Some record keepers do an annual fee. Some do monthly. I've seen some do quarterly as well. When the record keeper does not charge an initiation fee, their maintenance fees are higher, just generally across the board. When they do charge an initiation fee, the maintenance fees tend to be lower. So those are coming straight out of the participant's account. These are loans. These are optional things that the participant is choosing to set up. And so the participants bear the cost. This is not any fees that plan sponsors are paying. Okay, so for loans, the second question, first question is, how much money can I take? The second question is, how fast can I get that money? Inevitably, every time. So if you are going to be adding loans, or if you're somebody that's starting to take over and you're needing to help participants process loans, the most important thing to do is to understand the process for your specific record keeper in advance. Don't wait until somebody's like, hey, I want to take a loan, what do I do, before you research it. Have that answer ready to go. A lot of the record keepers allow the participants to go online. They have awesome websites where the participants can go in. They can not only see the maximum amount that they can take, but they can set up different scenarios. They can model different things. Well, if I take this much and I pay it back over 3 years, what is my weekly payment going to be out of my paycheck? They can do all of that online, so and they can do it at their fingertips. They can do it at night. They don't have to, interrupt their plan sponsor's day asking them all these questions, who then have to turn around and email somebody. It just makes it easier to have the participants go utilize those tools that the record keepers already have at their disposal. If it's available, apply for that loan online. It is so much faster. When a participant applies for a loan online, if NOVA is involved in that process, we get an instant notification from that record keeper. It is logged into our system and somebody is already working on it, in less than an hour. Usually, if it's during the business day, obviously, it'll be into our system. We have automation set up, and just that instant communication between us and that record keeper. Also, with the paper forms, sometimes it's really hard to read the handwriting. Sometimes participants forget to fill everything out on the paper form. They send it in and we're missing a bunch of stuff. With the online, it can't be submitted until it's complete. And then, of course, it's on the computer. So there's no question about, is this a E? Is this what number is this? And things like that can't be an issue. There's no missing pages of forms and stuff like that. Those are frequently things we run into with the paper. So apply online. And then request the ACH payment instead of a paper check. Paper check, of course, it doesn't affect the timing as far as getting that loan initiated, but it affects the timing of when they're going to receive that greatly, as we know. And then one thing we want to be very careful about over-promising to participants. They need to allow sufficient time to receive the funds. If they elect an ACH, 2 to 3 days is when that is going to arrive in their account after it's sent. A paper check, it could be a week for the mail. So they just need to understand it's not instantaneous and allow time to receive those funds. Okay, I have some examples here. Our first participant, super easy. Participant A's current vested account balance is $2,000, and they're requesting a loan for $1,000. The plan document allows one loan at a time, minimum $1,000, 50% of the participant's invested benefit is $1,000. So they can get the loan that they're looking for. Barely, but they can get it. This scenario happens all the time. One thing we have to watch out for is losses to the market. If overnight the account experiences losses due to how the investments did that day, and in the markets, their account balance is no longer $2,000, and it means that their loan request will fail. We like participants to get just a little bit above the absolute minimum before they make that request, because it is really disheartening to them when the loan itself fails because the market has dropped. So we'll absolutely do the best we can, but they just need to be aware that their account balance changes every single day, unless you're in some kind of a pooled situation. But people with a record keeper, it's going to change every day. Our next example, we have a participant with a vested account balance of $2,000. However, that $2,000 is including a loan of $400. Something super important to note, when a loan has been taken, it is still considered part of the participant's account. So when you're looking at their overall account value, some of that value may not be sitting in the account. It may be out as a loan. So that's what this situation is. It's $2,000, $1,600 of which is in the account, $400 is a loan. They have requested a new loan of $1,000. So this plan does allow 2 loans at a time with a minimum $1,000 withdrawal. So they've only got one loan. They could take another one. Let's see if they have enough money. What we have to do is take 50% of their account balance. So that's $2,000. 50% is $1,000. But because I have to subtract out that $400 that's already out in a loan, I only have $600 left in the account that I could pay out as another loan. Because 600 is less than the minimum loan amount of 1,000, we would deny this request. The participant would have to get that account balance up more or pay that other loan off in order to get their minimum loan amount back up to the plan's limit of 1,000. Example C. This one is another situation that people are kind of surprised by. We have a participant with an account balance of $100,000. They borrowed $30,000 in February and then turn around and fully repay it in April. So now their account balance is $100,000, no loans outstanding. They apply the next month for a second loan. So we have to look at that highest balance in the last 12 months. 50% of the vested account balance is $50,000. But remember that $50,000 is reduced by the highest balance in the last 12 months. Their highest balance in the last 12 months was that $30,000 that they borrowed in February. So 50 minus 30, the new max loan amount for this participant is $20,000. This one is super, super important for participants to understand. We do our best, but as if there's any plan sponsors here, what I recommend if somebody is going to repay a very large loan and their intention is to turn around and take another one, that happens sometimes. Participants think, oh, I took 30,000, I really should have taken 50. Maybe they're building a home, maybe they're, there's all kinds of situations where this could be needed. They think 30,000 will be enough, and then they realize, oh, man, I was wrong. I really need that full 50. Please talk to us before they pay it back, and we can walk them through this situation. I don't want somebody to fully pay back 30,000 and then be told they can only get 20,000. That is never that's never a good situation to explain to somebody if they've done it after the fact. So reach out to us first. We can help answer those questions like, hey, if I pay this off, what will my highest balance in the next, what will my highest balance be if I take another loan? And, in that case, we would recommend them to take a second loan. Yeah, you're going to have 2 loans outstanding, but at least they're going to get the money that they need. They're not going to be hit. We can look at other options. We can also look at options like, do they have rollover funds we could take a distribution of? Does the situation that they have potentially apply for a hardship? We can look at these things for the participant and we just don't want them to be burdened by, oh, I gave back all that money and now they're even more in the hole from where they wanted to be. Okay, whenever you have loans, you are inevitably going to have loan defaults. And of course, we want to avoid loan defaults as much as we can, but just know that it's something that happens, right? So in order to avoid them, only allow loans to be repaid through payroll deduction. If you set it up to where participants are making their own payments, I think I know of a record keeper that will allow the participants to go online and make payments towards their loans. When you choose that as the way, participants are inevitably going to forget. They're going to be late. They're going to have an unexpected expense pop up and they'll say, okay, well, I can't make that bill this month. I'll make it next month. It doesn't take long for the loans to go into default. And so to prevent that, just make it through payroll deduction. The best way to handle your deductions is to set that loan up in your payroll system immediately. When you're setting it up, review that start date, make sure it matches. You'll be given an amortization schedule for every loan that is taken out of the plan. And you can enter a goal amount into your system. And it's just basically, there's a number of payments that'll be on the amortization schedule times the payment amount, and that's going to be your goal amount. If a participant goes on a leave of absence for whatever reason, any reason at all, definitely reach out to us and to your record keeper. In some situations with some record keepers, the TPA kind of handles everything, and so the record keeper doesn't really care in those situations. But of course, it certainly does not hurt to let them know. But in those situations, NOVA would be the one, tracking that and helping you with that. And other record keepers, it doesn't matter if NOVA knows. If the record keeper doesn't know, then nothing's going to happen. These are the record keepers that have like loan management systems where they automatically default if a loan isn't repaid. So if they don't know, oh, they're on a leave of absence, they don't know to freeze the loan, then it gets defaulted. So if somebody goes on a leave of absence, let your TPA know, let your record keeper know at the same time. What will happen? A loan can be frozen for up to a year. And then when the participant comes back, whenever it is, we can re-amortize the loan and get you a new amortization schedule that you can follow going forward. Just because the loan is frozen, interest is still going to accrue on the loan. And when they come back, they can choose to make a balloon payment to get them back on track, or we can just re-amortize it so that all the interest is kind of taken into account and you get a new payment amount. If we don't take care of those loans, maybe we don't set them up in our payroll system and it goes a few months without them doing it and it defaults. If the participant just stops paying it, it's going to be costly. And it's not going to be costly to the plan or to the plan sponsor. It's going to be costly to the participant. The amount of the loan that's outstanding when it defaults is going to become taxable. The participant will get a 1099-R that following January showing that taxable amount, showing they haven't paid any taxes on it. It is going to, if they're under 59.5, it's going to be subject to that excise tax. So that's where all those costs, it can create a significant tax burden, especially if it's a larger loan for the participants. Whenever you terminate your employment, it is not called a default, it's called an offset, but kind of the same situation applies. They have to pay taxes on that outstanding balance, excise taxes apply, things like that. So it's better to avoid it if we can, but people are going to terminate employment. It's going to happen. It's okay. If you have a loan that is missing loaner payments, we do have some options available to prevent a full default. So we can do what's called a balloon payment, where a lump sum of all the payments missed, adjusted for interest, are made immediately to the record keeper, and then you can just kind of follow your schedule from then, your amortization schedule, as if nothing happens. That one is typically not used just because oftentimes the participant doesn't have the amount out just hanging out in their checking account that they can just send in. So what typically has happened is that the loan is re-amortized, and the payment amount increases a little bit to cover any accrued interest, but we can still get it paid off. There is a grace period. So if a loan is missing payments, it's going to be a mouthful, but I'm just going to say it. You have until the last day of the calendar quarter following the calendar quarter in which the first payment was missed. So first quarter, if I miss a payment in January, I have until the end of June to get it fixed, to either make that balloon payment, get back on track, or to re-amortize that loan and start my payments back up. If I miss the payment at the very end of March, I still have that same length of time. That my due date or my grace period date doesn't change. So depending on when in the quarter you miss that first payment is going to determine exactly how long you have to fix it. If you notice, a loan got off track, maybe you switched payroll providers and there was an error in the system. Maybe the participant went on a leave of absence and nobody said anything. Maybe, even if it's just a shorter leave of absence, it can affect things. Just let us know as soon as you catch it. The faster we catch it and get it fixed, the less of a burden it will be for everybody. Okay, let's talk about vesting, because vesting, we've mentioned a little bit before, they can take 50% of their vested account balance. So what is vesting? Vesting is an employee's ownership right to the benefits in the plan. It is something that accrues over time based on a schedule that is going to be defined in your plan document. So it's only going to apply to certain money types. The employer, specifically money types, are subject to vesting. Employee money is never subject. Deferrals, any Roth deferrals, rollover sources, that all came from the participant. They don't have to earn that money. But the employer money sometimes needs to be earned in order for them to be able to keep it. Certain contributions that are our employer, based on the regulations, must have 100% vesting. Those are your safe harbor contributions, QNEC, QMAC. It says rollover there. That will always be 100% vested. We're looking at things like typically your employer match, your employer profit sharing. Those are subject to the vesting schedule in the plan. There's two different ways to define how we calculate this. In order to figure out the vesting, I have to know how many years of service a participant worked. What is the year of service? I can define that using an hours method, counting hours, or I can define that using elapsed time. For counting hours, I'm going to look at the plan year, and I'm going to see how many hours that participant worked during the plan year. The regulations state that you cannot require more than 1,000 hours. So that's what most plans use, is 1,000 hours. It takes the average full-time person. If you work exactly 40 hours a week, every week, you will hit 1,000 hours in 6 months. So even a part-time person working 20 hours a week is going to hit 1,000 hours by the end of the year. So that's why you can't go above 1,000. You could, in your plan document, write something lower than 1,000. You could put 750 hours if you want, but that's pretty uncommon. People usually just keep it at 1,000. So for every plan year that the participant works 1,000 hours, they're going to get credit for 1 year of service. And we're going to look for, we're going to look at when they were hired, go all the way back to their hire date. We're not going to look at when they became eligible for the plan, because that's going to obviously leave off a chunk of their history. We're going to look at all the hours they have worked for the company. There is the ability to use something called the equivalency method if you don't actually track hours. Maybe all of your employees are salaried employees, and it doesn't really matter to you how many hours they work, so you don't track that. Maybe, everything was lost in a fire and you don't have the actual hours worked. We can use the equivalency method. Typically, it's 190 hours per month that the participant worked, but your plan document can define that even further down than that. So definitely the plan document is super important to read through and to make sure we know what is in your specific plan. With elapsed time, instead of looking at hours, I don't care at all how many hours they worked. It is basically anniversary date. It's very literal. When you have worked 1 year, you get credit for 1 year of service. So if I'm hired on August 1st of 2024, then on August 1st of 2025, I got 1 year of service. I don't care about hours worked. I personally love elapsed time. It's just easier. I feel like they're faster when we're trying to figure out vesting for a particular participant before we can process their distribution. I never have to reach out and email anybody to ask how many hours they worked. I can just literally look at their dates. I love it. Okay, so I have a couple of examples here. So participant A has been credited with 2 years of service. It's on a 3-year cliff schedule. That's the other thing. You can have all kinds of different schedules. Cliff schedules, like this one, mean you're 0%, 0%, and all of a sudden you fall off the cliff and become 100% vested. So this person has 2 years of service. So looking on our chart there, we see 2 corresponds with 0% vesting. But how much, if they're making a distribution request here and they've terminated and they have 5,000 in deferrals and 3,000 in match, what would their distribution amount be for? Well, deferrals are always 100% vested. The match, because they were only 2 years in our 3-year cliff, stayed at 0% vested. They're going to get all of their deferrals, which is $5,000. That match that was not vested gets moved to the plan's forfeiture account. Some people call it a cash account. The participant does not get to keep any of it. In our next example, we have a participant that has been credited with 4 years of service. This plan has a 5-year graded schedule and has the following account balances. So we can see 4 years corresponds to 80%. And notice their sources. They've got deferrals, they've got profit sharing, and they've got safe harbor match. So for this person, safe harbor and deferral are always 100% vested, but the profit sharing is the one subject to vesting. They had 4 years, 80% vested. They're going to get 80% of the profit sharing. 20% of the profit sharing is going to be moved to the forfeiture account. And then that 80% of the profit sharing is added to the deferrals and the safe harbors, and that is their distribution amount. All right, I know that's very simplified on vesting. It gets really complicated when people leave and they're rehired. But for the general overview, it's just a way to earn that employer money by, having service with your plan sponsor. Okay, let's talk about avoiding the most common problems. Whenever we have forms that are not in good order, we affectionately call them NIGO around here. We have to put them on hold, and we cannot process them. We can't, get them as quickly out the door as we want to. So the issues with distributions, a lot of distributions are done on paper still, and everything that we have with paper is an issue, whether it's a distribution or a loan. I could be missing pages. I could be missing things where they didn't realize that they needed to sign, or they didn't complete their address on the form, or they forgot something. I'm frequently missing a termination date if somebody is terminated. Nova only gets a census once per year, and so if they've terminated this year, I'm not going to know about that. So what I recommend is when somebody terminates employment, for the plan sponsor to get that into the record keeper system. I know we always check the record keeper system before we email the client and say, hey, we're missing data. So if we can find it ourselves, we're going to find it ourselves. But, sometimes people don't add it to the system, and we have no choice but to ask the client. Sometimes forms are hard to read. I really like online, like I said, because it eliminates so many of the problems, but the online task can still have the issue of missing a termination date. With hardships, I'm missing documentation or the self-certification forms frequently, so that's also the issue. With loans, again, for the first 2 bullet points there, especially that middle bullet point, it's usually a situation where the participant didn't fully fill out the form for us. Payroll frequency, if we're doing payroll deduction, I need to know how often they're paid so that I can set up my amortization schedule to match their actual pay dates. I want my first date on that amortization schedule to be that next payroll date. And I want, if they're paid weekly, I want my schedule to be weekly. So I need that information. Also, the loan term, that's the length of the loan. People almost always leave that blank on a paper form, and I'm not sure why. But online, they have to fill that in before it can get sent to us. So that middle bullet point there is only an issue for paper. Hardships, I mentioned the documentation or self-certification form. We almost have to put every single hardship on hold. Not quite, but almost. All right, cybersecurity. The files all listed on the screen here, these are things that have socials, dates of birth. We could have addresses. We could have, just all kinds of information that needs to be protected. We take security of information extremely serious at Nova. And so I just want to make sure everybody knows that we do not want these files sent without some kind of security measure. They don't send us anything like this without encryption. If you don't know how to encrypt things yourself, you can ask us to send you an encrypted email, and then your response back to us will be encrypted. We also have Plan Sponsor Link where people can upload files directly to us rather than having to email it all. That would be my preference. I want to get away from email as much as possible. So here, that is where our secure portal is, that link to it. And you can actually pick on there who you want to send it to. So if you want to send it to your account manager, you pick them. You can also choose Nova Distributions. We set my team up as if it was an employee so that, don't send it to me directly. What if I'm out of the office? What if I'm sick that day or something like that? That way you send it to the team and anybody on the team can grab it. We get an instant notification that it's out there, and immediately we can go get it. We do have the encryption software, like I mentioned. We are happy to send you an encrypted email if that works better for you. And just that way you're replying it safe back to us. We also have lots of policies and procedures. Our email accounts, our emails automatically delete after a specific amount of time. And so we have very strict procedures for Nova employees on how to handle their emails. Whenever something is emailed that is encrypted, we have to save it out of the email and delete that immediately. We don't want to keep it in the email. I know it's unlikely, but if an account was phished, then somebody would have access to that. So we get it out as fast as possible from that unsecure location. We do not add new contacts to our system without it being authorized by an existing contact. Somebody can't just call us and say, hey, I'm the new primary contact for ABC plan. Somebody from ABC plan has to tell us about that person instead before we'll add them. Every single quarter, we have mandatory training for every Nova employee. It doesn't matter if all they do is answer the phone or if they are actually handling testing for a plan. We all have security training, cybersecurity. In addition to that, every team has different training. I know the distributions department has mandatory training every 45 days, just because we do see a higher volume of very sensitive participant information, and we want to make sure we're staying on top of and up to date with every threat that's out there. We also have a very strict password policy. We utilize software to keep an eye out for breaches and things like that. So I just want to give that peace of mind to y'all, and then also help ask that y'all keep that things in mind when you're sending us data as well. Keep it secure on your end too. This is pretty much the end. So just a reminder of that CPA credit. Fill out that survey. It's going to happen at the very end of this. It'll pop up. Fill it out in about a week. You'll get your certificate. My information is on the screen there. And the team information, participant line team email is first, and then mine is right below that. Are there any questions or anything like that? I know this is so much information.
It doesn't look like there's any. Oh, looks like we do have one.
Okay.
Actually, no, it's just a type. So it doesn't look like we have any questions. If you guys want to, we can give it a few minutes to see if anybody has anything.
Yeah, I can stay on for a few minutes if anybody has a question, or feel free to use my email. I'm available. I can definitely get back to you if you do think of something later in the future.
Right. So it doesn't really look like we're anything, so I'll go ahead and do my closing, and if we do get questions, Melissa, then I'll just go ahead and ask you. So just another reminder, if you guys do want this presentation, I wasn't able to get it uploaded, but you guys can email us at webinars@nova401k.com, and I can get you guys a copy of this handout. If you do want to go back and rewatch this, it will be available on our YouTube channel by the end of the day. You can also rewatch any of our previous webinars here as well. Thank you again, Melissa, and thank you everyone for joining us today. Alrighty, I'm gonna go ahead and end it.